The Nigerian government raised a total of 2.5 trillion naira from Treasury bills and open market operation auctions as investors continue to show strong demand on lower stop rates on the one-year bill. Ayodeji Ebo, Managing Director of Optimus by Afrinvest, joins me to discuss investors' appetite for government securities. Ayodeji, thank you for joining us today.
Yeah, thanks for having me. Good afternoon.
Afternoon. It's quite interesting to see the surge in demand and this very huge interest in government securities, treasury bills, especially. Let's talk about the latest auction. I'd like you to walk us through the key takeaways from this auction, starting with the demand for the 364-day bill.
So interestingly, when you look at the demand, when we say bid to offer, is about 3 times, so about almost 1.9 billion relative to the amount that is on offer. And what we're seeing is that investors are looking at the direction of interest rates. So when you expect that interest rates would decline, the rational thing for an investor is to lock in to the longer end of the curve. So what happens is that it reduces their reinvestment rates. So when rates comes down within the next few months, for those that have locked in into the one-year bill, will not be impacted. So you would see that there's less demand for 91-day and the 182-day bill. Secondly, what we're also seeing is that with the stability that we are seeing within the FX space, for those that speculate at times around the FX and for those that also want to invest in that space, you look at what the potential return that you may get if it's not as attractive. You know, when you look at the last auction, which closed at about 70.4, that still gives a yield of close to about 20%. So, or 21%. So, which is still relatively attractive. So that is one of those are the reasons why we continue to see demand. So you want to play very safe, lock in, because when you consider reinvestment risk, which is the risk that if your investment matures, you may have to invest at a lower rate, which reduces your overall return. So this, I think these are some of the reasons why investors are trying to play long, and they are very aggressive within that space.
And if what the CBN has been doing is anything to go by, it looks like that is actually what is likely to happen. Of course, expectations of future monetary policy adjustments. Next meeting, obviously, in a couple of months' time. But how is the CBN too going to be responding to this going forward for the three tenors that we saw? Between 18%, 18.5%, 20% each. How much lower can these rates go in the subsequent auctions? What kind of rates are you expecting?
Okay, I think that the rate of decline would also reduce. Yes, while we expect demand to improve. So maybe by the time it's getting to the 16 levels, we may give to a yield of about 19%. So for the CBN, for them too, they are also trying to balance. The rate has to also be attractive. You look at the OMO auction at 19%. It has to also be attractive to attract FPIs. So there would need to be a balance. What we expect at the next MPC meeting, if rates, let's assume it's dropped to about that 15-16% stop rate, which is a yield of about 18-19%, they may also want to begin to lower the MPR from the current 27.5% to be able to see that impact on the lending rate. And as we progress, we may also see a reduction in the CRR, because the current CRR is not, that's the cash reserve ratio for the banks, especially for commercial banks, at 50%, is also increasing the cost of borrowings.
Right, and also let's talk about the bond market. Talk to us about the trading action on the bond market this week across the yield curve. What do we need to know?
Okay, yeah, thanks. So we also saw demand also within that curve, that space, and with also investors trying to lock in. So you will see within the mid to the low level, to the low end of the curve, there's continued demand. and investors are a bit wary, so which is creating like a curve, inverted yield curve. So what would continue to see is that investors would to lock in. There was a point in time, yes, the profit takings, because when you look at the yield in the last 2-3 weeks, prices have increased, which also present opportunities for investors to also take profit. So, but by and large, we also expect that rates will also moderate as we progress, and investors are trying to quickly take advantage of this current high rates so that they can lock in their investment. And for the traders, for those that don't hold to maturity, you trade price, so you're expecting that price will increase as yields drop, which is also positive for your portfolio.
And ultimately, I mean, between treasuries, the fixed income market in general, the government is always keeping an eye on debt servicing, on the debt service burden, and trying to make sure that rates are at sustainable levels for the government to be able to sustainably pay back all of this debt. What are your thoughts on how the government is managing or the government strategy in general to achieve a good balance of, yes, attracting and keeping investors with good enough rates, and also ensuring that the debt service burden isn't too heavy?
So I think it's really a tough one, given the high borrowing rate. But when you look at the structure of the government debts, 60% is in Naira and 40% is in dollars. So we expect that based on the current interest rate, exchange rate stability, the rates may stabilize within the in terms of the valuation of the debt may stabilize for the FX portion, but we continue to see increased borrowing. So debt management is really going to be challenging because while you are trying to manage the interest on what is being borrowed, the amount that is being borrowed has also increased, as revealed in the 2025 proposed budget. So there's a need to really pay attention to that, so that most of the revenues, if is not being used to also service debt or pay back debt.
All right, Ayodeji, we'll leave it there. Thank you so much for sharing that with us today. Ayodeji Ebo, Managing Director of Optimus by Afrinvest, taking us through trading at the fixed income market this week.